Inadequate financial investment management can lead to a situation where long-term investment provokes shortage of current assets, which can lead to bankruptcy. Budget definition: revenue and expenditure plan for a specific period, for example, year. The budget shows the directions of action and the resources needed to achieve it, so that the cooperative can provide the income planned for its members, as well as to compare the achievements with the desired results. Three important issues to be addressed in the budget are planning, implementation, and monitoring. Budgetary surveillance is important because you may want or need to spend more than planned. In this case, the need for additional expenditure needs to be assessed, and the budget must be reprogrammed. In any case, it is necessary to understand how to cover additional expenses, for example, from additional members' contributions. For cooperatives founded with the aim of realizing the members' output with as much added value as possible, this position will constitute the largest proportion of the revenue structure. Revenue should cover both the cost of purchasing the product and the costs of operating and developing the cooperative. The biggest challenge is being able to pay members a reasonable price for the products that they deliver. In the startup phase of a cooperative, it is acceptable if the price for the products supplied to the members is slightly lower than on the market. However, in the long term, the members of the cooperative must obtain more than if they were not involved in the cooperative. Staffing costs is an important part of the expenditure. It is imperative to provide adequate funding for the head of the cooperative, who should be neutral and unrelated to the cooperative. When buying material from members, it is possible for the cooperative to buy them cheaper because of a larger volume, so it's possible to offer their members a better price. In addition, taking into account the financial situation of the cooperative, it's also possible to offer members to purchase materials with post-payment. Now here's an important point. The aim of the cooperative is not to make the most of the surplus, but to maximize income for its members. However, it should be remembered that cooperative development will require resources, so it's good to work with a surplus where members decide how much to leave for the cooperative and how much to pay for the members themselves. It's important to remember that even if the planned budget is in surplus at the end of the year, in reality, it may be that there is not enough money to cover current expenditure for a month. Therefore, when drawing up a budget, it's necessary to compile the cash flow by month. Without investment, the development of a cooperative is not possible. Postponing the investment decision postpones the opportunity to increase competitiveness, which, in the long term, means lower income for cooperative members. Investment decisions are therefore not postponed, but should be made with careful consideration. The most important things to remember when making investment decisions are, first of all, assess whether the planned investments pay off. Second of all, determine the amount of investment required. Third, figure out the time required for project implementation. And finally, calculate project-related expected cash flow, evaluating whether planned investments pay off. The easiest way to determine whether an investment pays off is by setting a payback period. The longer the payback period, the less reason for implementing an investment project. For example, for a machine with a useful life of, say, 7 years, if the payback period is up to 5 years, the investment is economically feasible. If it's 5 to 7 years, you should probably carefully consider whether to make this investment. Cash flow should definitely be planned with caution. If possible, review the amount of investment. And if it's 7 or more years, it's probably not economically feasible to invest. When making a budget and making a decision to invest, the question arises, from where to get the money? For a new cooperative, it'll be easiest to get money from internal sources, such as from member contributions. Now, if the cooperative is already running, this could be from the surplus at the end of the year, if there is any. In other cooperatives, a certain amount of each agricultural unit sold by the farmer, such as say 1 cent of each liter of milk sold to the cooperative, is deducted throughout the investment period. Another approach is the so-called Quota Method. Under this model, the farmer anticipates how much he will sell to the cooperative. Then the cooperative calculates the value of the quota based on the amount of investment needed and the total output. The farmer pays for the quota, thus financing the necessary investments, or part thereof, if other sources of financing are used. From external sources, there are cooperative member loans, and it might be possible that in your country, there's a special support policy specifically for the development of new cooperatives through grants and subsidies. Loans from banks for new cooperatives are difficult though, or even impossible, as long as the cooperative does not have a history of business or collateral when it starts its business. Therefore, even if banks would agree to grant a loan to a new cooperative, they would require collateral from members of the cooperative, such as guarantees, pledges, or something else. Cooperatives who already have a history of economic activity can also look for money from both internal and external sources. Successful business history will facilitate access to bank loans as well as short-term loans from various suppliers. For example, plant protection products are received by the cooperative in the spring but settled after the harvest in the autumn. When looking for money, it is important to remember that short-term loans do not finance long-term investments, and vice versa. Otherwise, a situation may arise where long-term investment leads to a shortage of working capital, which can lead to insolvency. In summary, first, budget preparation and control is an important step for the cooperative to provide its members with a planned income. Second, although the annual budget might be in surplus, there is a possibility that in some months it is not enough to cover current expenditure. Therefore, a cash flow should be drawn up together with the budget. Third, by postponing the investment decision, the cooperative reduces its competitiveness in the future. So, investment decisions should not be postponed. Fourth, invest only in projects that are economically justified. Fifth, during the realization of the investment project, additional expenses do arise, which create additional pressure on the cash flow of the cooperative. 6. When looking for money, the cooperative must consider both internal and external sources. 7. When looking for money, it's important to remember that the short-term loans do not finance long-term investments, and vice versa. Now here's a few questions to think about. First, which competences are important for someone who will be responsible for the cooperative's budget planning and control? Is it wise to trust the budget planning to a member of the cooperative? Second, what are alternatives if, for example, after evaluating the investment period for a processing company, you come to the conclusion that the planned investment isn't economically viable? Should you trust processing to an outside source? And third, what, in your opinion, are the most realistic financial investment sources for starting the work of a new cooperative?